Welcome to the Certa Corner, our weekly office hours conversation with three CFP professionals who spent the last 20 years advising families, building plans, navigating markets, and sitting in just about every seat across the financial planning world. Each week, we'll give you a behind-the-scenes look at the conversations happening inside our team, the questions we've been hearing from clients, the planning issues we're debating, and the insights we think are worth sharing. Our goal is simple: to make financial planning and wealth management feel more approachable, more practical, and more connected to real life. We're glad you're here, and we hope you enjoy the conversation.
Welcome back to Certa Corner. We really appreciate you guys listening in today and also taking some time to listen into our last episode. My name's Chris Calloway again here, and I'm with my two partners from Certa, Herman Ramirez and Steve Balch. And we want to take some time today to talk about kind of some of the hot topics that are going on in the market. One of them being the IPOs and really just IPOs in general. Obviously, SpaceX took up a lot of news over the last couple of weeks. We don't really want to concentrate on that, but we want to just kind of look at the IPO market, look at some things historically, maybe some entry points, and just some ways to think about how they fit into your portfolio from a personal perspective. We also want to look at some things around concentrated stock, as well as some of the big names that we've all been talking about for years with the Mag 7 and how we've seen some change in the market. We've seen some names that have kind of come into favor and maybe fallen out of favor a little bit, and maybe some psychological hangups there. So just getting into it, just starting off, we're going to shift gears and go over to Steve and talk about just kind of the IPO market overall and maybe some of the hot topics that people have been talking about, and then kind of bounce a few questions off there. So Steve, if you want to lead us off talking about the IPO side.
Yeah, no, I appreciate it, Chris, and welcome to episode 2. I hope everyone enjoyed episode 1, and this is a fun little thing we're doing. Definitely, I feel like every topic headline has been about the SpaceX IPO, right? That's been everyone wants a piece of the company and stuff like that. And I'm not here to tell you it's going to be good or bad or anything like that, because I don't know. I have no idea, right? I think Musk has created a phenomenal company, and what they're doing with everything going on with the rockets and the Starlink, and there's a lot of projections going forward, right? But we did kind of dig in, and we released that email around the time SpaceX was going live, because now you have Anthropic and potentially ChatGPT and a lot of big names coming. And I get it, right? These are companies that potentially are generational changing companies for what's going on. And you see the idea that it could potentially be a significant boost to your portfolio. And the caution in what we had issued was, it's not to say SpaceX is bad or good. It's just IPOs tend to come out with a lot of hype, and the idea behind the IPO is not to price it at what the fair price is. It's to price it at what they can get the best price based on the momentum of the market and what's going on. And in a way, especially some of these larger ones IPOing at trillions of dollars of valuation, there's only so many buyers you can find out there. And so in a way, the retail investor is becoming the
new fuel,
the liquidator for the original investors, so to speak. And so they may end up being great investments long term. Part of our idea that we were warning people on is it's not a no. It's just let's be cautious, because historically, if you look back at some of the most recent large IPOs we've had, and I believe, I can't remember the name off the top of my head, came out and had the research paper, and it kind of went all over the internet. And he basically talked about how the average down period for the largest IPOs was a 50% drop at some point. And so the idea is there's a lot of volatility in these stocks. There's a lot of unwinding that goes on. And it's weird. And SpaceX has been a little bit different than other ones, but it comes public. It comes onto the markets public to the average investor. The original investors can't get out of it, right? They have to wait for 30 days, 180 days, whatever the cutoff may be. And so you have these very small floats. And so tight floats give you wide spreads, and that's when the stock kind of moves back and forth. And then they've been private, so you can't see what's going on fully behind the scenes. You don't know what all the cash flows, you don't know all the profits are. And so now you start to see when they get um, their first earnings calls or second earnings calls, you start to see behind the scenes of kind of what's going on, and then the market starts to kind of fairly price it. And I get the idea, right? You look at Amazon, you look at Apple, you look at Google. They've done phenomenal. And if you have been an investor over the last 10, 15, 20 years of some of these companies, you've done very well. So it's not to say that these can't do that again. But Facebook, which has done a tremendous job in its growth since its IPO, it was a pretty messy situation. It IPO'd, it lost over 50% in the first year at some point. It kind of froze the market too. And so IPOs can be one, if you are an original investor, it can be a tremendous windfall for you. But if you are on the market looking for it, it's not to say don't do it, right? It just is to be cautious at the end of the day and watch and kind of see. And that's what we've been telling clients. And it's been, hey, it's not a no, but it's a let's wait and see what happens. Let's kind of let the dust settle. You never want to chase, right, on the up or the down type of situation. And for some clients, we kind of went to the point at the end of the day. I also, you don't know if you're gonna be right. I hate don't buy it yet, and then it takes off, and then everyone's like, oh wait.
And to your point, a couple questions that popped up while you were talking. I think one good thing, I think you were alluding to. So Steve and I are big University of Miami Hurricane fans, but the professor from University of Florida is kind of the go-to on these IPOs. So maybe we could share that link. He's got a ton of information going back almost all the IPO history. He's kind of the guru, and I think we've all read his insights. But with that being said, you talk about entry points, and I think there was something that the two of you or the three of us were saying to clients or friends who were talking about it. That let me ask you this in two ways. One is like, hey, listen, you said X amount of your net worth is a good entry point, so that's one question for you. And then two is there's all these lockups, right? So all these people that were issued these stocks, whether they were the janitor or the head engineer, they have these lockups that could be 30, 60, 90, 180 days, 6 months, a year. I think Musk is just over a year, if I recall correctly. So like, talk about some of those entry points, and then from a net worth perspective, because the same thing, we don't just want to tell people no, right? If they want it, we live in a world of FOMO, or myself included sometimes. So it's like, what is maybe a good entry point?
Yeah, I mean, I think it's the rule that I kind of have manipulated into the 90-10 rule, right? You think the yours are the 80-20, right? If 80% of the work's done by 20% of the people, or vice versa, whatever it may be. I look at portfolio construction of, everyone talks about the big hits because that's what's exciting. It's, I bought Apple at $2 and held on, and now I have all this. Like, okay, then that's the rare case that ends up. And I think everyone wants that quote unquote lottery ticket. And I look at kind of the 90-10 rule. If 90% of your portfolio is in core diversified asset allocations, meeting your risk tolerance and the allocation to meet your long-term goals, you're going to be in a pretty good spot, right? And yes, the theory of finance is 100% to be in your core assets, but that's not how human behavior acts, and people do want access to what's going on. And so if you've got the core set up and you have a little bit extra to the side, and you go and say, okay, I'm going to take 2 to 5% of my net worth, and I'm going to put a little bit into this new IPO or this new hot stock that's out there, or this momentum stock, and it doesn't do well, or it blows up, or it goes to zero, then you haven't destroyed your retirement. You haven't destroyed your goals. You haven't destroyed the plan. And if it does really well, okay, well, that's another part of the plan we have to plan for, right? And so it's kind of keeping your feet in both buckets, and kind of easing into that standpoint. From an entry point, it all depends, right? And so there's ways you can think about it. If you say, hey, look, I'm buying this stock, believing it for the long term, you put a small percentage in, and you kind of let it ride and say, I'm just going to let it be. That's fine. I've seen people say, hey, you know what? I'm going to put 2% of my net worth in, and I'm going to buy, every month for the next 6 or 12 months and kind of try to dollar cost average in. I'm not going to try to time it. There's no right or wrong. The math, it's hard, right? Because now you're talking about two different situations. The math tells you from buying on the index, if I buy today in the index, historically speaking, I'm going to be in a good spot no matter what happens, right? The longer I hold, the less chance I ever have a loss. I think it's like once you get past 20 years of buying the US stock market, the losses are like, the gains are like 98%. There's been only a handful of times over a 20-year period you've ever lost by buying and holding. A stock, though, historically speaking, stocks don't do very well, right? It's really a small percentage of the stock market, or stocks that drive the market, so to speak. Most underperform treasuries. And so there's a lot of risk in holding one individual stock in that position. And so, we want to make sure that there's a lot of talk about gambling versus investing, right? Investing is having a plan around what you're trying to do. Gambling is taking a large percentage of your assets and buying or betting on one stock to do well. And it can do very well, but it could also create a significant loss in your portfolio and drastically change your outlook of what you're trying to accomplish, right? And so it's the special sauce of each person's different, and finding that personal standpoint of, it's not a no, it's not a definite yes, it's finding what you feel comfortable with and taking a calculated risk so that if it doesn't work out, you haven't lost your shirt, so to speak.
Right. And if you're somewhere on the fence, right, it's eventually going to make its way in one of those indexes you referenced, and you're going to hold it in one way, shape, like, SpaceX, just based on its size and some new rules, what have you, is 1% of the triple Qs, I think, today.
Yep.
And then we'll grow to X. So most of our clients are going to own it anyways.
Correct. Yeah, within the next probably couple weeks to by the end of the year, sometime in that time period, depending on the index, if you have that, if you're invested in the U.S. stock market, you will have these IPOs in some exposure in the future.
Right. Which I think kind of leads into a little bit of the next topic. We talk about, concentrated stock or owning one stock over time and how it's lagged the indexes. A lot of the clients before now SpaceX are, big Tesla fans, right? So Herman's, spoken to us about, and he can share a little bit about, the concentrated stock side and, the Mag 7 and just the turnover we see in these individual stocks that what was around 30 years ago or was the top stock is not the case today, so to speak. So if Herman, you can touch on that for a little bit.
Yeah, we do tend to see a lot of concentrated stock, specifically with executives, and so there, in a way, there's a risk of two, which is one is you work for XYZ company, and then your stock is also a lot of your wealth might be tied into one stock. So you have an issue from a planning perspective in that, if the company, if there's a layoff, that means maybe the company isn't doing well, right? And that means your job might be at risk, right? And on the flip side, if you get lucky enough to work for some of these bigger names that have done really well over the years, it becomes a good problem to have, right? Which is, hey, I have a lot of money in one stock, and now I have to figure out a way to unwind it from a planning and tax perspective, right? So we've actually seen both sides of it, where unfortunately clients are working for, they're making good income, maybe they're executives with the company, and they're making, $500,000, $1 million a year, but their stock compensation is not great. So it's weighing down their planning. They're getting more grants and RSUs and options in that world. On the other side, you can also have the situation where it's, doing very well, and then next thing you know, we have to figure out ways and methods to reduce their concentration, right? We have tended to see that quite a bit with a lot of the tech companies, sometimes in healthcare as well. And then every so often, you just get a client who gets lucky, or not. Maybe they just were shrewd investors and they end up making a really good move and buying, low and something that's a 10 bagger, right? We've seen that as well. And so methods around that we've been able to employ today, it really depends. Hey, where is it? So we've also seen situations where clients have it in 401ks. They're buying employer stock in 401ks. So there's very interesting tax planning you can do through something called net unrealized appreciation, where you can actually extract out the employer stock out of the 401k into a taxable account and turn something that normally would be ordinary income into a capital gain asset, which is super interesting planning. We've seen that quite a bit, specifically down here in Florida with Nextera stock, which is FPL. Other situations where maybe we have clients who are in an underperforming name and we're just systematically selling it, right? It's, hey, we're targeting a certain percentage of your net worth, going back to the IPO situation. We're saying, hey, if it exceeds 5 or 10%, we're just going to systematically sell it, right? And we don't really have a big affinity for it, okay? Yeah. And then in other situations where, maybe it's being held for many years and it's, a situation where there's a lot of gains, we may need to do more complex planning. We've done options collaring where we're really trying to freeze the value of the stock. If a client, plans to hold it forever, you do get a step up in basis upon passing. So you could evaporate tremendous gains by holding on to it. But in the meantime, you don't know what the stock performance is going to be, right? And then on the, in other situations, there's now new tax-aware strategies we're employing that allow us to take other assets to, generate offsetting losses that can help unwind and transition positions over time. So like most things, the financial industry is always innovating, always looking for ways to, gain an edge, as well as it relates to tax planning, derivatives plannings, et cetera. So it is an area of focus in our practice, and we have quite a few reps there. But it really is going back to what we've been talking about, kind of a planning situation where we really need to understand where are those assets held. Are they held in a taxable account? Are they held in a 401k? In some cases, people have been very shrewd and held stuff in Roth. So now they have all these tax-free gains, right, in a very nice place. My general rule is once you get past 25% of assets in one stock, you got to kind of have to start really thinking about, all right, what's my plan for, reducing my concentration risk in one name. Right. We all hear that Enron fiasco and WorldCom fiasco and Lehman Brothers, and we can always name these blue chip stocks that weren't supposed to go to zero, can kind of go to zero, or they may not go to zero, they just may underperform, and you are just better off in the index. So having some sort of process to understand concentrated risk, and then kind of dovetailing into just concentration in general, we see that in the stock market with S&P 500 situation, where right now there's a big concentration in 7 names, which are the 7 names that are funding all the AI capex. And so there's essentially some concern around how sustainable that is and whether the indexes are set up for a period of underperformance, where they've been in a period of outperformance, and just generally looking at how the constituents in the stock market have changed from a concentration risk. If you look at what the leading stocks were in the 1950s, 60s, 70s, 80s, 90s, it is a moving target of names. There is no name that was here 50 years ago that is still at the top today, and the names that are today aren't likely to be the names in the next 10 or 20 or 30 years, right? And so the index has a way to self-correct itself, but part of that comes through underperformance. And so something we look at quite a bit is really strategy diversification, not just saying, hey, we own 3 index funds that are all very highly correlated that own thousands of stocks. That's not really diversification anymore if they all kind of move the same or they own the same thing. So concentration is a big thing. Single stock risk is a big thing, whether it's an IPO, whether it's an established company, whether it's in the index. It's something we think about. And there's financial planning strategy diversification tactics, and there's also investment strategy diversification tactics. And we think good planning is really looking to just aggregate both.
As planners, we definitely have the tools, and we have more tools today than we did in the past, which are definitely great. But something that we'll just touch on for a second, because sometimes we have to put our psychology hats on, right? When we're talking to clients, is the emotional side, right? And that goes back to, I worked for this company for 20 years, or my dad owned this stock and I inherited it from him, and it goes right back to GE was X years ago, and obviously now it's spun off and there's things they're doing well, but there's a lot of stocks that have done great in the past, and then people get emotionally tied. So how do we deal with that?
Big one. Steve, what do you think?
It's hard, right? It's finding, as I say, that shade of gray, right? There are the fundamental theories that we all learned when we took our test, got our CFP and things like that of how you're supposed to act. And then there's the real world of what actually has to happen. And each person's different, and you have to kind of work with them to find what's there. Some people need tough love. Some people need their handheld, right? Sometimes you got to arm wrestle. Sometimes you don't. We don't like to arm wrestle. That's not our style, right? We definitely like to educate and show you, right, through examples, through charts, through historical events that have happened. And then kind of try to guide you along. We're never going to kind of say, you should do this, you're not going to work with us type of standpoint. The ones that do want to hold the position for various different reasons, we build in the portfolio, we build the game plan of like, okay, well, we'll reassess in a month, we'll reassess in 3 months. Hey, we're going to start trimming some off, at least kind of planning. Particularly in the end of the year, right? Maybe it's like, hey, we have some losses, we can offset and kind of start trimming, from that standpoint, right? But there's always examples, right? There's always examples of what has done well, what hasn't done well, and there's always the lead, right? We were talking about it just before in the Mag 7s, and everyone's like, you got to buy the Mag 7. You got to buy, first it was FANG, then it was the Mag 7, and this is what you need, and these are the best stocks. And then it was always 7 stocks versus 493 stocks, and really it was only the Mag 7 doing well. Well, the market's up over 10% year to date in 2026. It's had a really good year, resilient year, and the Mag 7 a couple weeks ago was negative for the year. And so we just don't know what's going to continue. There's actually a whole blog post I'm working on for in a couple weeks from a paper from 2023 about concentrated stock positions. The median stock, right? The median stock, so your typical stock, underperforms the index over a 10-year period by roughly 8%. So that means your typical stock is going to underperform the market. The top 20 performing stocks, the ones that have been the best performing stocks over the last 5 years, over the next 10 years, historically, they underperform by almost 18%. So almost 2% a year. And so it's very hard for the winners to continue to lead and grow. And I have to probably test this with the internet and do my own research and everything. But I remember someone always using an example and telling me, in 1999, if you retired and you had $1 million in Microsoft stock and you took 4% out every year to live off of, how much money would you have today? And people are always like, well, you'd have multiple millions of dollars, right? Microsoft's been this great company and it's been one of the leaders and it's probably top 4 or 5 in terms of market cap. And you would have run out of money in 2012 because that's how poor Microsoft did between 1999 after the tech bubble bursting and then really through the financial crisis and didn't really recover until they got a new CEO in 2012. And so even though it's a great company, right? It's about buying at the right time and stuff like that. So that's that's a long-winded way because I can't give you a short answer, right? But it's working with the client.
The point is to work with the client individually and what's best for them, and also like we always say, you can't fall in love with the stock, right? You can't be emotionally tied to them. So it's part of our job to help weave and navigate through the changing market. Because that's the landscape is always changing, right? There's no other way to put it.
It's always changing, right? And it's not trying to find the hot thing, right? It's in Japan was the stock market to be in the 80s, and if you were in Japan and when it peaked out, up until recently, a handful of years ago, you hadn't gotten back to positive had you invested at the top. And then it was all US in the 90s. And then from 99 to 2009, this US stock market returned negative 1%. And then it was alternatives, it was real estate, it was commodities, it was foreign stocks. And then from 2010 to recent day, it's been US again. We don't know what's going to be there. And it's our job to diversify, to quote unquote, almost make your portfolio boring, right? We're not trying to outperform the market. You're not hiring us to pick stocks for you. We are there to help you create a cohesive strategy around your risk tolerance, tax planning, estate planning, cash flow management, retirement, and looking at everything, and then risk, and how do we manage the risk of the concentrated position or the IPO, whatever it may be in this standpoint.
That's great. Hey, I really appreciate that. And then, you know, we really just want to take a few minutes to go over these things today, kind of quick and concise. Herman, if you've got any closing thoughts, let us know.
No, I think this is a good spot to end it. We covered a lot of different topics. I think it's interesting, discussion, and these are things we face on a daily basis, right?
Yep.
And so it's one of these things where the market is and a very interesting animal. It's always changing. There's always things, but there's also things that always stay the same. And to your point, Chris, one of those things is the behavioral aspect. So it's funny that that you did bring that up. That could be a whole show in and of itself.
Yeah. And with that being said, and we appreciate, everybody who's listening. Before we started this call today, we're always interested in new topics. So if anybody out there is listening, there's something on, front of their mind that you have a big question about, we could create a whole podcast around that. So please share your thoughts. And we thank you for your time, and thank you, gentlemen, for your time and your insight and wisdom. And we look forward to seeing everybody in the coming weeks.
Yep. Thank you for listening. And we always like to hear from you also. Let us know what you want us to talk about.
Cool. Thanks, Steve.
All right, guys. Thanks a lot, guys. Bye.
All right. Bye.
The information given here is taken from sources IIP Advisors, LLC, DBA Independent Financial Partners, IIP Securities, LLC, DBA Independent Financial Partners, and its advisors believed to be reliable, but it is not guaranteed by us as to the accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or a solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IIP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situations, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purposes without IIP's express prior written consent. Investment advice offered through IIP Advisors, LLC, DBA Independent Financial Partners, a registered investment advisor. IFP and Certa Financial Planning are not affiliated.